Real Estate Intelligence Daily, July 3, 2026. Commercial real estate finance, capital crunch spurs office reckoning. The commercial real estate finance sector is feeling the aftershocks of an interest rate supercycle that has squeezed debt markets and sent property owners scrambling for solutions. Financing costs remain elevated after the fastest run-up in borrowing rates in decades, triggering a wave of refinancing challenges and distress, especially in the troubled office segment. In a symbolic echo of the 4th of July, an analysis by Trepp Incorporated highlighted that many of the U.S. original 13 colonies are now fighting a different kind of battle. Skyrocketing commercial mortgage delinquencies on half-empty office towers amid persistent remote work headwinds. This surge in defaults and underwater loans is forcing property owners and lenders alike to confront a new reality. The once stable pillars of urban real estate finance are trembling under the weight of high interest rates and shifting demand. Commercial search. +1. Crenez. +1. Despite headwinds, financiers are engineering creative lifelines to stabilize assets and navigate the capital crunch. Traditional 10-year loans are giving way to shorter 5-year deals as a new norm in commercial mortgage-backed securities, CMBS, issuance, reflecting lenders' caution in an uncertain rate environment. Loan brokers report that deals still pencil out for well-leased properties, but often with higher equity requirements or innovative structures. JLL Capital Markets, for example, just arranged a $66 million refinancing for a Baltimore waterfront office building in a resilient submarket. In New York's Manhattan Plaza District, Rhythm Capital is securing a $415 million refinancing for a trophy office tower, showing that elite assets can still attract big capital even as secondary offices struggle. Some owners are tapping specialized funding. Atlanta's iconic CNN Center, amid a major overhaul, just obtained $56 million in CPACE green financing to retrofit and reposition the property, highlighting how sustainability-linked lenders are stepping in as other capital sources retrench. These adaptive financing strategies underscore that creativity is paramount for borrowers trying to shore up cash flow and roll over debt in a rising rate environment. Crenez. Commercial search. Broader macro currents are beginning to shift in favor of a gradual recovery, sparking cautious optimism among industry leaders. Mary Lou Peck, president of BOMA International, noted in her annual State of the CRE Industry speech that the recovery is here, selective and uneven, but here. Roughly 70% of senior real estate executives now say capital is more accessible than a year ago, and many believe asset values could start rising as the economy stabilizes. Higher interest costs are forcing market discipline, but there's a silver lining. Repriced assets and improved fundamentals are drawing investors back to U.S. real estate, including a renewed wave of interest from Asia. Cross-border capital, after a lull, is cautiously returning as peak rate volatility appears to be behind us, opening the door to a new cycle of investment. There's a growing sense that commercial real estate finance is turning a corner, one marked by sobering lessons from the office downturn, but also by fresh avenues of capital and resolve. In navigating this era of higher costs and shifting uses, the industry is forging financial innovations that could sustain not just our cities on Earth, but even inform how we finance bold projects beyond our planet one day, demonstrating resilience and optimism in the face of adversity. Commercial search. +1. Commercial search. Commercial search. PropTech and AI analytics, AI agents, smart buildings, and the data-driven future. Real estate's technological transformation is accelerating with property technology, PropTech, and artificial intelligence, AI, analytics moving from hype to essential tools of the trade. AI is now seen as a critical productivity lever in the property sector, with a new generation of AI agents and machine learning systems working as digital assistants for brokers, asset managers, and developers. These advanced AI agents can execute complex multi-step tasks, automating document analysis, running comparative market research, optimizing energy usage, and even drafting initial valuations, freeing human professionals to focus on strategic decision-making. Rather than replacing people, The rise of AI in real estate is augmenting human expertise, reducing repetitive work, boosting consistency of due diligence, and turning vast data sets into actionable insights. The conversation has shifted from simple chatbots to integrated AI assistants that can scour portfolios with superhuman speed, and the result is a more informed, agile industry poised to capitalize on insights that were once buried in spreadsheets or siloed databases. Some forward-looking firms have even begun integrating large language models, LLMs, tailored to real estate data, hinting at an era where every property stakeholder has a virtual consultant at their side to simulate scenarios and foresee outcomes.
LinkedIn.
+1. Smart building technology and advanced analytics are not just theoretical, they're fundamentally changing how assets are managed and valued. Commercial landlords are investing heavily in IoT sensors, cloud platforms, and predictive analytics to turn their office blocks, warehouses, and malls into living buildings that generate real-time data and adapt to occupant needs. Key priorities include energy monitoring systems, occupancy analytics, predictive maintenance, and comprehensive sustainability reporting, aligning building operations with ESG goals. These smart asset management tools provide granular visibility, from HVAC efficiency to foot traffic patterns, and help cut costs while enhancing tenant comfort. Notably, at a recent BOMA conference, industry leaders stressed that buildings embracing technology to become highly responsive, efficient living systems are commanding greater investor interest. In the crucible of the hybrid work era, landlords are using analytics to navigate shifting usage patterns down to the day of week, flexibly adjusting services for peak occupancy days while conserving resources on slower ones. This data-driven agility not only protects income streams, but could also improve long-term asset valuations, as technologically advanced properties weather economic storms better than outdated peers. Commercial search.
LinkedIn.
The PropTech revolution extends beyond building operations into design, construction, transactions, and even the concept of real estate itself. Virtual reality, VR, and digital twins are routinely employed for property tours and planning, compressing deal-making timelines and connecting global investors to local assets without stepping on a plane. Generative AI is being harnessed for tasks like rapid site planning and optimizing floor plate layouts, enabling architects to test countless designs at the click of a button. Even tenant experience is being reshaped. Mobile apps powered by AI can track space usage, tailor amenities, or simulate entire communities for planning smarter cities. These shifts point to a positivist, futurist trajectory where technology helps solve real estate's toughest challenges, from climate control to cost overruns, while keeping human needs front and center. Far from cold automation, PropTech's greatest promise lies in creating healthier, more sustainable buildings that serve people better. At the same time, this wave of innovation has an eye on the horizon. The technology mastered in today's smart buildings, sophisticated sensors, AI management, and autonomous systems could one day help us design and maintain resilient habitats on the final frontier, from Martian colonies to lunar bases, extending human-centric development into the cosmos. Construction and development tech, robots reshape building amid slowdown. As construction and development face economic headwinds, technology is stepping up to transform how we build. High interest rates and caution in capital markets have put some projects on pause, slowing housing starts and commercial groundbreakings in many cities. In places like Florida and California, skyrocketing borrowing costs and lingering supply chain strains have sharply curtailed new deliveries. In Orlando, for instance, multifamily completions in early 2026 fell to less than half the prior quarter's volume as developers pulled back. Yet necessity is proving the mother of invention, spurring a pivot toward adaptive reuse and innovation in building methods. Across the country, downtown office towers with rising vacancies are being reimagined as apartments, a trend that soared 340% this year over last. Meanwhile, big tech infrastructure projects like data centers face a new challenge: community pushback. Local groups concerned about noise, environmental strain, and power usage have forced the cancellation of at least 25 data center developments in the past year, a quadrupling of shutdowns compared to 2024. This grassroots opposition is emerging as a key constraint on new high-tech facilities, pushing developers to engage with community stakeholders and innovate in design, such as water-saving cooling systems and noise mitigation, to earn local support. Krenes. In this climate of change, construction robotics and automation are hitting a breakthrough moment. According to a comprehensive 2026 industry report by Zacua Ventures, construction robotics have finally moved from experimental pilots to daily production use on job sites. Builders are deploying specialized robots for tasks like surveying, bricklaying, rebar tying, and site inspection, reaping dramatic gains in speed and safety. Venture investment in construction robotics soared to $1.36 billion in the first 3 quarters of 2025 alone, more than double the total funding in 2024. On sites where these machines are used, they can accomplish in hours what used to take days of manual labor. Robots tie rebar on a bridge project up to 5 times faster than human crews, and autonomous layout printers can mark out floor plans over 4 times quicker than traditional methods. Far from threatening jobs, these robots address critical labor shortages and relieve aging construction workforces from dangerous, repetitive tasks. Contractors report that drones for routine inspections and Boston Dynamics Spot robot for site monitoring are now standard equipment on complex projects, reducing delays and costly errors. The takeaway: after years of hype, automation is finally delivering real results in construction, cutting costs and accelerating project timelines when the industry needs efficiency the most. BuildWig. At the same time, 3D printing technology is expanding from demonstration prototypes to full-fledged home building solutions. In places like Austin, Texas, entire housing developments are being built with 3D printed concrete walls, part of an effort to tackle the nation's affordable housing crisis. Rising material costs and a persistent shortage of skilled labor have made these innovations more attractive. 3D printers can erect a home shell in a fraction of the time it takes with traditional methods, often yielding strong, energy-efficient structures resistant to pests and weather extremes. Industry pioneers like Icon's Jason Ballard tout these homes as sturdier and more cost-effective, addressing multiple pain points with designs that are at once faster to build, more resilient to disasters, and flexible in architecture. Overall, the construction sector's embrace of robotics, automation, and new materials is driving a quiet revolution on job sites and in city plans. As developers learn to treat machines as routine tools rather than novelties, we can expect safer and faster construction, progress essential for meeting housing demand on Earth and perhaps one day, for constructing human habitats among the stars. Fox Business. +1. Fox Business. BuildWig. Insurance and risk management, climate costs, resilience, and data revolution. Intensifying climate threats are profoundly reshaping real estate insurance and risk management, forcing a hard reckoning with rising costs and coverage retreat. Property insurance premiums have skyrocketed by roughly 70% in the past 5 years, with homeowners now paying an average $2,370 annually for coverage. This surge reflects a brutal loss environment. 2024 alone saw at least 27 extreme weather disasters in the U.S., causing $1 billion plus each in damage. Large insurers, facing unprecedented claims from wildfires, hurricanes, and floods, are pulling out of high-risk regions or freezing new policies, leaving communities exposed. California and Florida, scorched by wildfires and battered by storms, have been hit especially hard. Market giants like State Farm and Allstate have stopped accepting new property insurance applications in California to stem their losses, while Florida's fragile insurance market endures soaring premiums and insurer insolvencies. The implications are severe. A deepening protection gap means more homeowners in hazard-prone areas may find their properties effectively uninsurable or unaffordable to insure. This cascading risk threatens both individual finances and broader housing markets as lenders grow wary and authorities scramble to bolster last resort coverage programs. Yet, even as coverage recedes in some areas, a silver lining emerges. The crisis is galvanizing efforts to harden homes against disasters through mitigation incentives and to explore new insurance models like parametric policies, fostering resilience. Risk management in real estate is swiftly pivoting to incorporate climate analytics, regulatory compliance, and advanced technology. No longer a distant concern, physical climate risk is now considered a financially material factor in property valuations and lending decisions. At the 2026 ULI Resilience Summit, experts emphasized that wildfires, floods, and extreme heat are increasingly baked into underwriting models, with regulators starting to demand transparent risk disclosures from companies and investors. Forward-thinking states have taken action. California's new Climate-Related Financial Risk Act, SB 261, mandates that large corporations assess and report climate risks, signifying that resilience has become a requisite part of due diligence. Investors and insurers alike are rewarding resilient, well-prepared properties with better access to capital and coverage, while penalizing those that ignore adaptation. Meanwhile, data science and AI are revolutionizing risk evaluation. Insurers are harnessing machine learning to crunch vast property datasets, enabling more nuanced, precise underwriting and predictive risk analytics than ever before. These systems can assess building materials, maintenance records, flood zone maps, and even 3D digital models of properties to flag vulnerabilities, forecast potential losses, and incentivize proactive risk mitigation by owners.
Oli.
+1.
Oli.
An archipelago. +1. This fusion of technology with risk strategy is giving rise to a new paradigm of holistic real estate risk management. Insurers are rolling out dynamic, data-driven policies that adjust coverage and premiums based on real-time property conditions, cutting costs for owners who invest in stormproofing or energy resilience, and raising flags on those who don't. At the same time, climate scenario planning is becoming standard practice at big real estate funds and REITs. By early 2026, over $2.4 trillion in global commercial real estate assets were under some form of climate scenario analysis due to investor and regulatory mandates. The results of these analyses are profound. Properties in high-risk flood or fire zones are starting to trade at measurable discounts, reflecting higher insurance costs and future retrofit expenses, while green-certified buildings often command rent and value premiums from tenants and buyers. Insurers like Swiss Re and Munich Re are now selling advanced risk scores to inform pricing, which, in turn, encourages property owners to fortify assets to secure better terms. With insurance now directly tied to resilience, risk managers are stepping into a strategic role, guiding acquisitions, capital improvements, and community planning to preserve long-term value. The big picture is sobering yet hopeful. Though climate change poses a formidable test, the industry's moves toward better data, smarter coverage, and heightened resiliency echo a commitment to safeguarding not just investments, but communities. Real estate's success has always hinged on managing risk. Now, with the stakes higher than ever, these innovations may prove critical not only for thriving on a warming Earth, but also for inspiring how we confront risks when humanity eventually ventures far into space's harsh environments. An archipelago. +1. Sustainable Atlas. Sustainable Atlas. +1. Real estate investment platforms, mega funds, digital disruption and democratization. Real estate investment is buzzing with activity as capital seeks new avenues, from multi-billion-dollar funds to technology-driven platforms revolutionizing how deals are done. In a sign of confidence returning to property markets, global investment giants are amassing record war chests to deploy in undervalued assets and emerging opportunities. This week, private equity titan Starwood Capital Group announced the closing of its largest opportunistic real estate fund ever, a $10.2 billion vehicle, SOF 13, aimed at distressed and value-add deals across sectors from housing to data centers. The fund drew commitments from hundreds of institutional investors worldwide, eager to capitalize on repriced assets and an expected rebound in transactions. Similarly, Centerbridge Partners paid $750 million for a strategic stake in Merit Properties, a deal that values the Mid-Atlantic industrial platform at $3 billion and infuses capital to ramp up development of shallow bay warehouses across multiple states. Major investors are signaling high-conviction bets on resilient segments. Industrial real estate, logistics facilities, and specialized assets like data centers and life sciences are magnets for these new funds, aligning with broader trends such as e-commerce growth and technological infrastructure expansion. Fresh data from CBRE show U.S. commercial property investment volume jumped 19% year-on-year in Q1 2026 to $117 billion, with industrial deals leading the pack, a 23% surge to nearly $30 billion year-to-date. Even as higher interest rates temper some buyers, the dry powder on the sidelines is immense. The savvy capital now being assembled could fuel a wave of strategic acquisitions and recapitalizations, potentially revitalizing markets from Boston to San Francisco in the coming quarters. Commercial search. +1. But it's not only big institutions reshaping the investment landscape. Digital real estate investment platforms are maturing after a turbulent shakeout, promising broader access and new models. In recent years, online platforms enabled thousands of everyday investors to buy into commercial properties, but some early exuberance ended painfully when market conditions turned. A vivid example, a prominent sponsor's collapse in 2024 left around 800 investors chasing more than $60 million in lost funds, exposing gaps in oversight and trust on one major U.S. crowdfunding site. That and other setbacks forced a reckoning. Now, industry players have responded with stronger safeguards, strict third-party escrows for investor capital, regulatory compliance upgrades, and partnerships with established institutional managers to restore confidence in these vehicles. The result is a leaner but steadier field of real estate crowdfunding and fractional ownership platforms, where offerings are vetted with greater scrutiny and liquidity features, like secondary trading windows, are gradually being introduced. The sector's painful lessons were amplified by the Federal Reserve's rapid rate hikes in 2022 to 2024, which hammered private real estate values and underscored the risks of illiquidity and office exposure. Today's platforms are more cautious, focusing on diversified portfolios and clear risk disclosures, which is helping them regain momentum as complementary channels to traditional funding. With global interest in property investment rising, these tech-driven platforms are increasingly acting as a bridge, connecting large-scale projects to the crowd's capital and giving individuals a chance to own fractional pieces of assets that were once the preserve of pension funds and billionaires. Angel Investors Network. +1. Angel Investors Network. Perhaps the most forward-looking development is the convergence of real estate investment and blockchain technology, which promises to further democratize access and improve efficiency. On the same day Starwood was touting its mega fund, a Nasdaq-listed asset manager, Caliber Costs Incorporated, announced a breakthrough in its bid to tokenize real estate funds using Chainlink's blockchain-based compliance infrastructure. This initiative is aimed at solving the last mile of making private real estate funds easier for a broader swath of investors to access legally and seamlessly in digital form. Caliber's strategy, now moving from concept to implementation, is integrating tokens representing fund shares within regulated markets, ensuring each digital transaction meets identity verification and compliance requirements automatically. The company's CEO, Chris Loeffler, frames tokenization as a pragmatic way to tackle private real estate's perennial pain points, valuation transparency and liquidity, by eventually enabling real-time, compliant trading of fund shares similar to stocks. This marriage of proptech and fintech suggests a future where raising capital becomes faster and more global, unleashing new investment sources for development from Main Street to Mars. While blockchain does not eliminate risk and remains in early days, its adoption by mainstream players underscores a futurist mindset permeating real estate finance. All told, From giant opportunistic funds to agile crowdfunding sites and tokenized assets, the real estate investment ecosystem is reinventing itself. The common thread is optimism in innovation and resilience. Capital is adapting to new realities, and in doing so, it is expanding the possibilities of what and where we can build next. Taiwan News. +1. Taiwan News. Disclaimer: this report is for informational purposes only and does not constitute legal, financial, or medical advice. All content is based on news and market analysis, and any forward-looking statements reflect current industry commentary and should not be construed as investment advice.